Stop scrolling for a second. If you've checked your portfolio balance 15 times today or refreshed the silver price ticker like it is going to show you a different reality in the next 30 seconds, take a breath. Because what happened in the silver market over the last few hours doesn't fit the profile of a normal correction. This wasn't simple profit taking. This wasn't a textbook pullback. This looked like a mechanical shift, one that often happens when large financial institutions and exchange-level policies tighten the rules in real time. Today is Thursday, January 29th, 2026. Earlier this morning, silver traded up to $117.73 per ounce, the highest price it has ever printed in this narrative. It broke through levels many analysts thought would take years to reach. Momentum was strong, sentiment was turning, and then the move reversed, fast. By early afternoon, silver had dropped to about $103.89, down roughly 6.55% on the session. If you are leveraged, that kind of move is not volatility, it's a forced decision. And that gets to the core point of this market analysis. Moves like this don't usually happen in isolation, and they don't usually happen without a mechanism that accelerates liquidation. So let's be precise about the mechanism. The primary tool here is the margin requirement change, what most people call a margin hike. It sounds boring, it sounds like plumbing. But in futures markets, margin policy is one of the most direct levers that can amplify selling pressure without anyone needing to predict a top. Here's the plain English version. When you trade silver futures on Comex, part of the CME group, you are not paying the full value of the contract. You post a fraction as collateral. One contract represents 5,000 ounces of silver. Instead of putting up hundreds of thousands of dollars, you might post something like $22,000 in margin to control that exposure. That's leverage, and leverage cuts both ways, because the exchange can raise those margin requirements whenever it chooses. And when it does, every participant holding a position has a simple choice: wire more cash immediately or reduce the position. That's not market psychology, that's a liquidity constraint. In this script's timeline on January 7th, 2026, the CME group announced a major margin increase, about 47%, raising maintenance margin from roughly $22,000 per contract to about $3,500. That's an additional $2,500 per contract required. Now scale that. If a large fund holds 100 contracts, you're talking about more than $1 million of incremental margin that has to show up fast. If a retail trader holds 10 contracts, that's an extra $105,000 they may not have. Even if the thesis is correct, the math forces action. And in practice, when enough people are forced to reduce exposure at the same time, it creates the same outcome. Selling begets selling. The timing is what makes people pay attention. In the narrative, silver had just pushed through $110. Momentum was building. Shorts were under pressure. The physical market was signaling stress. Lease rates in this script rose to about 8%, compared to a typical range around 0.3% to 0.5%. When lease rates spike, it often reflects tightness in the availability of metal to borrow. Whether you agree with every interpretation or not, it's a clear signal that something in the physical chain is under strain. So when margin requirements rise sharply into that backdrop, it functions like a circuit breaker, an intervention mechanism that can cool a rally quickly by forcing leveraged participants to step back. And this isn't the first time this playbook appears in the silver market's history. In 1980, as silver surged toward $50, the rules around new long positions tightened and the rally collapsed, wiping out concentrated players. In 2011, when silver hit $49, margin requirements were raised repeatedly, 5 times in 8 days in this script's telling, and the price fell sharply in the weeks that followed. The point isn't to romanticize any era. The point is that margin policy has repeatedly acted as a volatility amplifier at critical moments. Now add the institutional layer. This script names JP Morgan, noting that in 2020, the bank paid a $920 million penalty related to precious metals market practices, including spoofing. That's not presented here as a conspiracy, just as context that enforcement actions have existed, and that major institutions participate meaningfully in these markets. So when you see a margin hike coincide with a historic price spike, and you see large banks deeply involved in futures positioning and delivery flows, it's reasonable to interpret the move as an exchange-level stabilization mechanism, one that, intentionally or not, benefits participants who can handle higher margin and hurts those who can't. But here's where the story shifts from paper mechanics to something more important: the physical divergence. Because while the paper price was dropping on screen, the physical market behavior described here did not mirror that collapse. In this narrative, while futures were trading around $111 after the drop, physical silver in some regions was changing hands far above that. Figures like $130 per ounce are mentioned in places like Japan, alongside elevated premiums elsewhere. The phrase used is the great divorce. The paper price and the physical price no longer behaving like they're anchored to the same reality. And that's the key tension in silver price today discussions. If a futures market can print unlimited paper ounces, but the physical chain has limits, you eventually test where pricing power truly lives. Let's talk supply, because this is where the paper model gets challenged. Paper markets can create contracts instantly. Physical metal has to be mined, refined, fabricated, and delivered. That takes time, energy, and infrastructure. In this script, Comex registered inventories, the metal available for immediate delivery, are described as having fallen more than 70% since 2020. That matters because registered inventory is what supports the delivery promise. And then there's a specific drawdown figure. Between early January and mid-January 2026, about 33.45 million ounces were reportedly withdrawn for delivery from Comex, about 26% of registered inventory in a single week. If that pace is accurate, it signals that some participants are preferring delivery over paper exposure, and that preference, when widespread, is exactly what tightens the system. Now layer in the geopolitical supply shock. On January 1st, 2026, this script says China implemented a major export control regime by reclassifying silver as a strategic dual-use metal. Exporting silver would require government approval, and only 44 companies would have licenses to export over the next 2 years. Whether you frame that as security policy or industrial strategy, the implications are straightforward. Supply becomes gated. And when one of the world's key refining and processing hubs tightens the flow, regional premiums respond first. In this script, Shanghai premiums over London spot widened to about $8 per ounce, described as a record spread. That's not a small detail. Premiums are a real-time indicator of stress between screen price and street price. When premiums widen, it often means the paper price is not clearing the physical market efficiently. So the question becomes unavoidable. If physical is tight, if export flow is restricted, if inventory is draining, why does the paper price move like it's unconstrained? The answer, in this market analysis framework, is that paper liquidity can still dominate short-term price discovery, especially when margin policy forces position reduction. But that control tends to erode as credibility erodes, and now we reach the human cost of leverage. This script points to India, specifically Rajkot, where 44 silver trading firms reportedly declared insolvency after the margin hike and price crash, with combined liabilities of about $425 million. At the same time, physical silver in India was described as surging, reaching a lifetime high of around 2,59,692 rupees per kilogram on January 7th, roughly $113 per ounce after conversion. That contrast is the lesson. They weren't necessarily wrong about silver. They were exposed to the wrong instrument under the wrong rules. Then the script adds another pressure point. The CFTC commitment of traders report claiming commercial banks were net short around 212 million ounces as of early December 2025. If that number is in the ballpark, the incentive problem is obvious. At $100 per ounce, that's a $21 billion notional short. Every $1 move higher implies substantial mark-to-market pressure. So when the market rallies hard, participants with large short exposure have reasons to favor conditions that slow the move, like margin increases. That force leverage longs to reduce risk. Again, not an attack, but an intervention mechanism that changes who can stay in the game. Now, if you're holding physical silver, this changes the practical takeaway. Physical holders are not subject to margin calls. They don't get forcibly liquidated because a maintenance requirement changed. Their risk is time and price fluctuation, not an immediate liquidity trigger. So what do you do with this? First, if you hold physical, don't confuse paper-driven volatility with a sudden change in physical fundamentals. In this script, the drivers, tightness, export controls, inventory drawdowns, didn't disappear in 4 hours. Second, if you're considering buying, understand the instrument. Pullbacks created by margin-driven liquidation can widen the paper-physical gap. If your thesis is about physical scarcity, paper vehicles introduce settlement and policy risks that physical ownership does not. Third, manage your time frame. The script outlines 3 endgames. 1, the system resets higher, paper prices rise to reflect physical reality, pushing silver toward levels like $150 or $200 as shorts cover. 2, the divorce becomes permanent. Paper prices remain managed, while physical trades in a parallel market at sustained premiums. 3, force majeure. Delivery stress forces, cash settlement, and breaks paper-based price discovery, while physical prices move independently. You don't need to pick a prophecy. You need to track indicators. Watch registered inventory. Watch lease rates. Watch regional premiums. Watch margin policy. Watch how quickly paper price falls relative to physical availability. And here's the only CTA that matters for a serious investor. Don't outsource your thinking. If this analysis helped you see the structure, margin policy, paper liquidity, physical constraints, then keep following the data. Keep asking one key question every time silver price today whipsaws. Is this move driven by fundamentals or by market structure? If you want more market analysis framed this way, calm, numbers first, and focused on mechanisms, consider subscribing. And in the comments, answer this. Which indicator do you trust most right now? Comex inventories, lease rates, or physical premiums?